Now here in AET video 15 we have a very interesting transaction, and that's this one here on May 15th. Received a stock trailer as a gift from your grandparents valued at $1,600 with an estimated salvage value of $400. The reason why this is interesting is because it falls into a special category of not only how you acquired this particular asset, but the fact that it is a piece of equipment that is known as non-current inventory. And what that means is it's an asset or a piece of equipment that's going to be used for longer than 1 year. It may last for 10 years. So over a long period of time, you'll be able to use this equipment for a project or for an SAE or on the farm. For example, tractors on the farm certainly last for longer than 1 year. So they need to be treated differently in the world of business and in the world of the AET. Let's take a look here and see how this is going to work out. Because the transaction involves money, we will go to the finances. Now, this particular transaction is interesting because it is a non-current item, otherwise known as a capital item, and it involves assets that have a useful life over a long period of time, so long usage times. However, because it's a gift, it falls into an additional category, and that's this one right here, SAE non-cash entries. And there's a variety of these that can occur, but the one we're interested in is receive a gift. You get a gift of feed, materials, etc. that has cash value, but no money changes hands. Or you get a non-current capital gift. And that's what we're dealing with here in this transaction. So we'll click that. And then the non-cash capital item transfer window appears. The first step once we enter this window is to record the date. We look at our transaction and we can see that it's May 15th, 2019. We look at the transaction and see that the estimated value is $1,600. It's already selected as unearned income. We need an expense category. Let's drop that window down. Livestock, machinery, and equipment. That is the one we want to select. Give the item a name. That's our stock trailer. And then here's a description that you can use. You would type this in. My grandparents gave me a trailer for hauling my animals. Next, you would indicate the quantity, which is 1. Salvage value is what we believe this particular asset would be worth at the end of its useful life. We may use this for 3, 5, or 10 years, and so we're going to estimate what we think we can sell it for at the end of that time. And so according to our transaction, we have estimated this to be $400. And the last step here is to determine which depreciation method is used. And if we have time in this class, we can discuss this a little bit more. But at this point, it's an estimate of how long we think this particular asset will be useful. And so what we are going to estimate for this is 10 years. And this number is important because it's used to calculate how much of this total value is actually treated as an expense each year. We'll click Save. Let's go review that transaction. So here in the review window, referring back to previous video, for the loan payment, you can see that the first payment was made, 30% of the balance plus 2.5%. So there's the $600 for that principal payment. But then notice that the interest is handled as a separate transaction. It's a separate expense. This payment was to actually repay the loan. The $50 was an additional amount that had to be paid for borrowing that money. And then here we have on the 15th, there's our stock trailer. Non-current purchases, it was a gift. It's a capital item. And there is the debit value, $1,600. So that will conclude this video. Receiving a gift, and receiving a gift that is a non-current capital item.